Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today we're looking at PIWT Technologies.
And if you find our talks useful, please consider, subscribe, like, and comment underneath. It really helps. So, PIWT Technologies, this is a company making some very big promises.
Oh, definitely. It sounds a little dramatic, I know.
A little.
Okay.
They're talking about rewriting the laws of physics inside data centers.
Right, but if you actually dig in, they're trying to solve maybe the single biggest hardware bottleneck in AI right now.
Well, plumbing.
Exactly. The plumbing. Everyone is obsessed with the GPUs, the NVIDIA chips, but they're not talking about how you move data between those chips.
And right now, that's all done with copper wire.
Yep, data centers are just addicted to it.
Which has worked fine for decades. My Ethernet cable seems to work.
Sure, for your home internet, it's fine.
Yeah.
But AI models are completely different. When you push that much data at the speeds they need, we're talking 800 gigabits, even 1.6 terabits a second, copper it hits a wall.
A physical wall.
A literal physical wall. It's called the skin effect. The electrons get pushed to the outside of the wire, resistance shoots up, and the signal just degrades.
And resistance means heat.
Massive amounts of heat. It's like trying to push a fire hose worth of water through a tiny straw.
So your data center is spending a fortune just on air conditioning.
A whole fortune. The industry knows copper is basically dead for the next generation. The obvious replacement is light. Fiber optics.
Okay, but fiber isn't new. Why is this a startup conversation? Why haven't we just swapped everything out already?
Cost. And manufacturing complexity. This is the really crucial part. Standard optics are just incredibly hard to build at the chip level.
How so?
Traditionally, to build a transceiver, the thing that turns electricity into light, you have to manually align everything. Lasers, lenses, mirrors.
Manually? You mean like with tweezers?
Practically, yes. It's called
Okay.
active alignment. You have to turn the laser on, see where the light goes, nudge a lens a tiny bit, measure again, and then glue it all down.
That sounds impossibly slow.
It is. It's slow, it's expensive, and it does not scale. You can't just print millions of those things.
So the industry's stuck. They need light for speed, but they can't afford the way we make optics now.
Precisely. And that, right there, is the PIWT story. They've developed something they call the Optical Interposer.
The Optical Interposer. Sounds like a sci-fi device. Let's break that down. What is it, actually?
Think of it like a bridge. It's a platform made of silicon that lets them place lasers and lenses onto a chip using standard pick-and-place robots.
So no more turning the laser on and measuring.
None. That's the breakthrough. It's passive alignment. The components just snap into place with sub-micron precision.
So they took this bespoke, artisanal process and basically turned it into an assembly line.
That's it. That's the semiconductorization of photonics. They're putting light tunnels onto a chip. And the claims are pretty significant. We're talking a 40% reduction in energy use.
40%. In a data center, that's not an efficiency upgrade. That is pure margin.
Which is why the hyperscalers, your Amazons, your Googles, are paying very close attention. They need 1.6 terabit speeds, but they can't afford the power bill that comes with it.
Okay, I see the picture. It's a better mousetrap for the AI age, but, and this is a big but, I have to pull us back to reality.
Yeah.
I'm looking at the financials you sent over, and they are
Definitely.
volatile.
Yes.
Volatile. The trailing 12-month revenue was $762,000.
Correct.
And it gets worse. In 2024, revenue dropped to, $41,000? A coffee shop makes more than that? How can a company that calls itself critical AI infrastructure have the revenue of a lemonade stand?
Okay, so this is the most important part to understand. For years, PIWT was doing what's called NRE, non-recurring engineering.
Consultants speak for projects.
Basically, yeah.
Yeah.
Companies would pay them to run experiments. Can you build this prototype? Can you test this theory?
So they were a science lab for hire.
Exactly.
Yeah.
And that brings in some cash, but it's not a real business. It's not scalable. So in 2024, management made a really risky call. They essentially fired their customers.
They fired them.
They stopped all that custom work to focus 100% on productizing the optical interposer.
They burned the boats.
They did. That revenue drop was intentional. They sacrificed the short-term cash to build a scalable product. And now you're seeing the first tiny green shoots. Q3 2025, revenue ticked up to around $298,000.
Okay, 298 is better than 41, I'll give you that. But it's still barely a blip. How are they keeping the lights on?
The war chest. They just did a massive capital raise, $150 million.
$150 million. That was a registered direct offering, right? Usually that's a sign of weakness.
It didn't look like it. The price point was $7.25 a share.
That's interesting. Usually these things happen at a steep discount. That price suggests the institutions involved really wanted in.
And $150 million, that's a lot of runway. It changes the entire story.
How so?
Before this, the biggest risk was just bankruptcy. Would they run out of cash? Now, with that much in the bank and, get this, zero debt.
Zero debt.
Good.
That is really rare for a growth company burning cash.
Incredibly rare. So the bankruptcy risk is, for now, off the table. The risk shifts entirely to execution. Can they actually build it?
Let's talk about that burn rate. 150 million sounds like a lot, but it can vanish fast.
True, but they aren't building giant factories. This is where their fab-lite model comes in.
Fablight. Explain that.
It's the smart way to build hardware. Building a semiconductor fab costs billions. PO8 isn't doing that. They design the architecture, and they partner with existing foundries for the heavy manufacturing.
They outsource the expensive part.
Exactly. They're leveraging the billions other companies have already spent. It's kind of like how NVIDIA operates.
So they keep the intellectual property and ditch the capital expenditure.
Right. But they are still burning cash.
Yeah.
The net loss is around $50.5 million for the last 12 months. They're hiring, buying materials, prepping for mass production in Malaysia.
So $50 million a year burn rate against a $150 million bank account. That's a 3-year runway, give or take.
Which lines up perfectly with their timeline. They're targeting a big production ramp in the second half of 2026.
Okay, timeline's funded. What about the moat? Why can't a giant like Intel or Broadcom just copy this?
Well, a few reasons. The giants are mostly focused on pure silicon photonics.
Yeah.
But silicon is actually terrible for making lasers.
Physics again.
Physics again. So you have to literally glue a laser onto the silicon, which brings back that whole alignment problem. Peyote's interposer uses a hybrid approach, so they can just mix and match the best components.
It's like Lego blocks versus welding.
That's a great analogy. And once a data center designs their system around Peyote's engines, it creates really high switching costs.
Is anyone actually validating this tech, though? Who are their partners?
Some heavy hitters. There was Semtech for those 1.6 terabit receivers. They're working with Mitsubishi Electric. But the most interesting connection is Celestial AI.
Celestial, the AI accelerator company.
They just got acquired by Marvell.
And Marvell is a titan in data center infrastructure.
Exactly. Celestial was using Peyote's light engines. Now that Marvell owns them, Peyote's tech is effectively inside the Marvell ecosystem.
That is a huge vote of confidence. Marvell doesn't buy science projects.
It suggests the big players see this as viable.
All right, let's talk about the stock itself. When a small company dilutes by $150 million, the stock usually tanks.
And it's been a roller coaster. Year to date, the stock was up 40%. Then the financing news hit.
The dilution drop.
Of course. They added over 20 million new shares. The stock pulled back, 8 to 17% and settled into that 650 to 725 range.
Painful, but logical. More slices of the pizza.
But look at the volume. During that drop, over 8.6 million shares traded hands. That is incredible turnover.
What does that tell you?
It tells me that while some people were panic selling, institutions were stepping in and soaking all of that up. Big money was buying the dip.
Interesting. And what's the chart look like?
Technically, it's forming what could be a cup and handle pattern.
Okay, for everyone not staring at charts all day, what does that mean?
It's a bullish consolidation pattern. The stock goes up, pulls back in a curve, that's the cup, drifts sideways in the handle, and then theoretically breaks out higher. It signals selling is exhausted.
You also noted the beta is only 0.33. That seems really low.
It is. It means the stock is marching to the beat of its own drum. It doesn't care what the broader market is doing. Its price is moving based on its own specific news.
So an uncorrelated asset, but what's the general sentiment?
It's a battleground. You have the short-term pain of dilution versus the long-term hype. The engineering community is giving them awards. Their Teralite product just won a big innovation award.
And those judges are engineers, not stock promoters.
Exactly. And analysts are waking up. The consensus is buy, with the median price target around $7.30. But some of the long-term blue sky models are projecting targets as high as $34 or even $45.
$45 from 7. That's a huge if.
It's the scenario where they become the industry standard.
And that if brings me to my favorite part, the bear case. Let's interrogate the risks.
Let's hear it.
Risk number 1, execution. They are betting the entire company on this pivot from lab to factory. Hardware ramps are They're just notorious for delays.
It's the single biggest risk. Lab to fab is the valley of death for hardware startups.
If that Malaysia facility has a yield problem, if only 20% of the chips work, that $150 million just vanishes.
It burns up incredibly fast.
Risk 2, valuation. Even after the drop, this thing is not cheap. Price to book of 13.7, that's nosebleed territory.
It's priced for perfection, absolutely.
The valuation is entirely based on future promises. If the AI hype cools even a little, stocks like this get crushed first.
You're definitely not buying it for today's numbers.
And finally, competition. Marvell, Broadcom. Their R&D budgets are bigger than POET's entire market cap. What stops them from just crushing them?
They could try, but POET has a head start on the specific material science. The giants are like ocean liners. They turn slowly. POET's a speedboat, but it is a threat, no question.
Okay, we've weighed the science, the cash, the scary risks. Time for the verdict. What's your score for POET Technologies?
I've gone back and forth, but given their position and that new cash pile, I'm giving POET a bullish score of 8 out of 10.
8 out of 10. That is aggressive for a company that made $41,000 in revenue last year. Defend that.
The revenue is a lagging indicator. The leading indicator is the physics problem. The problem is real, the solution seems to work, and now the bank account is full. The question is shifted from will they survive to can they execute?
So how should someone think about this? Is this a buy and get rich tomorrow play?
Absolutely not. Do not day trade this stock. This is a swing trade with a 12 to 18-month horizon.
You're waiting for that production ramp.
We're looking at late 2026. You want to be positioned before the headlines change from promising tech to record revenue.
So patience is the key here.
Patience and a very strong stomach for the volatility.
Well, there you have it. POET Technologies, a high-stakes bet on the plumbing of the AI revolution. Definitely not for the faint of heart.
But if they pull it off, they really could change how the internet works.
That's our analysis for today. As always, remember none of this is financial advice. You have to do your own homework.
Check the filings, read the white papers for yourself.
And if you want us to look into another piece of the AI puzzle, just drop a comment below. We do read them all. Thanks for listening, and we'll catch you on the next one.